Mortgage rates in Canada increased another 50 basis points recently, the sixth hike this year. The latest rise marks yet another step back for would-be homeowners, but there could be some reason for optimism. Joining us this morning with more is Peter Sashecki from Everything Financial. Good morning, Peter. Good to see you.
Nice to see you, Carrie. Good morning.
Okay, so we hear about the Bank of Canada raising those interest rates. A lot of people are nervous. They don't feel they can afford a home anymore because of increased mortgage rates. But you're saying that something happened last week that could help calm some nerves. What's going on here?
That's right. 2 weeks ago today when we were in studio, the Bank of Canada raised the rates 50 basis points. But a week ago, mortgage rates, so long-term mortgage rates, 5-year mortgage rates actually dropped 50 basis points. So that's a sign of things to come. It was also because of the messaging in the Bank of Canada raising rates, saying they're kind of getting near the end. It's having the effect on inflation. That doesn't mean there's not going to be another small increase or maybe two small increases, but the truth is in the messaging. What also went down last week, though, was term deposit. GIC rates went down 50 basis points, and that's a sign that banks realize we can't go paying those rates because the rates on mortgages, which fund the GICs, those rates are going to go down in the future. So GIC rates, mortgage rates went down. No one even noticed, but that's a sign to calm people's nerves. That's a sign of things to come.
I just want to take a step back here because I think a lot of people would have this question. When the Bank of Canada raises an interest rate, is it not directly tied to mortgage rates? Don't those mortgage rates automatically adjust because of that?
Some mortgage rates do. So the variable rates automatically go up because they're tied to that rate directly because they're a floating rate. Home equity line of credit, or as we call them for short, HELOC rates, those go up right away as well because those are tied to the floating bank rate and the lending rate. But long-term rates are based on bond yields, based on what rates you're going to do 3, 4, 5 years, 1 year down the road even. And those rates saw a reduction because not what happened, but because what they perceive is going to happen.
Interesting. Okay, so there's something that's being promoted that you think people should be steering clear from. What's going on?
Yeah, this came up just like a wave last week of hearing this from all over the place. People out there telling people that next year rates are going to be going up 0.5% every quarter. You better buy a house now. You better lock in and rechange your mortgage now because there's a 2% interest rate coming. Apparently, those people promoting this irresponsible fear-mongering must have a crystal ball that the rest of us don't and know something we don't. Don't buy into the fear. Don't buy into being pressured with emotion and fear tactics that if you don't buy now, it's going to be even more unaffordable next year because these rates are going up by 2%. There's no basis for that. Nobody knows what's happening. And that's not what was in the message from the Bank of Canada. Nobody knows what's going to happen. So check your emotion at the door, look at things logically, and look at the surrounding message to see what's going on. Don't let fear ever guide a money decision.
Okay, so just quickly clarify that for us. How do rates and inflation affect the market?
Well, the markets are actually different from rates in the economy. When the word recession happens, the R word, the markets have already accounted for that. The markets are already in recovery mode. We've seen about 5 weeks of overall, there's still some down days in there, there's still volatility, but the market has increased considerably since the end of September, and that's during interest rate increases and what we see as a recession on the horizon. So, because we're technically already in a recession, based on the definition of recession. So the market and the economy are two different things. Market tends to be ahead of the economy because the people who do those things are already looking at what's coming. They see what's coming, interest rate increases, inflation, recession, and they've already made adjustments for it in the market. So don't assume because the economy's bad or inflation's up that your portfolio might be down as well. To the contrary, it's probably going up right now.
Okay, Peter Sashecki with Everything Financial with some advice this morning. Thanks for joining us. Have a great day. We'll talk to you next week.
Thanks, Carrie. See you next week.